Welcome back to Mr. Market. We're now into episode 14. Thank you so much for joining me. This past week was a bit of a roller coaster. We had the Federal Reserve raise interest rates by 0.25% as expected. And initially the market went up on the news because the wording had changed to suggest that the end is near for the interest rate increases. And when the market started to expect that there was only one potential rate hike left, they started to celebrate because that has been such a big headwind for the market over the past year. But I think during Powell's testimony, there were some words from Treasury Secretary Yellen that put a little bit of uncertainty with regard to the banking situation. They mentioned that they weren't thinking about securing some of those other deposits yet, and that's what caused the market to go tumble all the way until about Friday. And a couple hours into the day, the market started to rally. And from a potentially negative week, the market ended up rallying to about a positive 1.4%. So they snatched victory from the jaws of defeat. And overall, it ended up becoming a good week. So we had a pretty good week too. We were up $3,041, which put us up $20,800 for the year. And that is about 41% of our annual target of $50,000 a year off our $250,000 portfolio, which translates to 20% a year. And so, yeah, we're well ahead of our pace. I know things have been good so far, and I'm trying not to get cocky because when you do, that's when things really start to fall apart. But I'm pretty optimistic that we'll be able to go reach our goal for this year. Part of the higher profitability came from the elevated fear levels that we've seen in the market, and that shows up in the volatility index called the VIX. And whenever the VIX is high, our profits tend to be higher also because the premiums that we get from selling our put options are significantly higher than normal. But now things are starting to kind of taper down. I expect our future profitability will taper down and go back to more normal levels. When the Fed raised interest rates by 0.25%, the Fed suggested that rates were actually higher than it seemed because with the recent banking crisis, the banks were less willing to lend money to businesses, and that has a way of restricting the flow of money into the economy, which is effectively like another interest rate hike. And speaking of interest rates, now that the market sees a light at the end of the tunnel, they are starting to look towards the date when the Federal Reserve will start cutting interest rates. And in fact, there's actually quite a bit of an aggressive expectation that the Fed will cut rates later this year. Now, this runs contrary to what the Fed has said. The Fed has said, no, we're not going to be cutting rates this year at all. And if you take a look at the expectations versus what the Fed is saying, there's quite a bit of a divergence there. And time again, the market has been wrong. Whenever they've expected the Fed to cut rates, whenever the Fed has said, no, we're not going to, guess who ends up being right? The Fed. So I think whenever there's a gap in expectations versus what the Fed will do and what the market's saying, I think that opens up the possibility for some disappointment. And I kind of liken this to the situation with Charlie Brown and Lucy and kicking the football. Charlie thinks that he's finally going to be able to kick that football, but Lucy, the Fed, will probably yank that football right at the last second and disappoint the market again. So I would put my bets with the Fed and count on them to do what they said they'll do. I think the Fed needs to keep interest rates a little bit higher because the interest rates still aren't as high as the rate of inflation. And I think the baseline case is interest rates should go as high as inflation, and inflation being at about 6%, that's probably where the upper boundary should be. But because they're a little bit constrained, they can't quite go as high yet. And let's all remember why the Fed would even want to cut interest rates. The mechanism here is that the Federal Reserve will typically cut interest rates to stop the economy from falling into a deeper recession. Once the economy has passed this tipping point and is well on the way into a recession, that's typically when the Federal Reserve cuts interest rates. And if we look at the history for when they've done that, it has typically been a sign of danger because once they're cutting rates, that means the economy is in recession. And when the economy is in recession, typically that's when stock markets fall. So I think the market needs to be a little bit careful with what they wish for, because if they get it, that's probably a sign that the economy has gotten a little bit too weak for the Fed's comfort, and I think that will cause a little bit of trouble for valuations for the stock market going forward. So I'd be a little bit cautious once the Fed actually starts cutting interest rates. Oh, and I also found this interesting chart that shows the history of what the stock market does during periods of rising interest rates. And if history is any guide, the odds are we'll probably just chop around here until the end of the year and not really head in one particular direction or another. The market certainly doesn't know where it wants to go. If you take a look at the chart and zoom out a little bit, you'll see we're starting to form what's called a wedge. That's where the highs are being sold off and the dips are being bought. And it starts to kind of just converge into one single point. And then at that point, the market will decisively break out in one direction or another. Do I know which way it's going to go? No, I have no idea. But my job is to go follow the market and follow its trend and not argue with it. So whichever direction it goes, that's the way we'll go too. And that's been the key to our success for the past year. And with rates falling so much, the fair value based on my really crude valuation metric tied to the 10-year treasury, the fair value for the market is somewhere around 393 all the way up to about 415. So it's leaning more bullish than bearish. Okay, let's talk about our trades. So for last week, I told you that I had sold some puts at the $375 level for the S&P 500 ETF SPY. And at that point, once the market opened for the following week, it started to lean a little bit more bullish as we were going into the Fed decision. So I added a couple layers. I added some at 380, and later on in the week, I added another layer at 385. And I even got more aggressive as some of the volatility started to rise. And so I sold call options on the VIX index, symbol VXX. So I sold some at 70, and I sold some more at 65. And all those ended up working pretty well. Now, I did have one trade that worked against me, and that was me when I dipped my toes into the water, into the banking index. I mentioned to you last week that Barron's had put out a headline saying, hey, buy the banks. And I showed you the chart that it looked like it was a little bit too early, and it was. But I did try my hand at it. I put a very, very short-term moving average, a 9-day moving average, and very briefly, when it crossed above it, I got the weakest buy signal, and I thought, sure, let's go try to play this. And so I sold some put options over at the $42 strike price, thinking, oh, great, it's got about a 9% downside before it goes into money, before I have any particular losses. And with only a couple of days left, I thought, sure, the odds seem pretty good. The delta was about 0.12, somewhere around there. And I thought my odds were pretty good that I wouldn't lose any money. But, that's how it goes. This is such a volatile sector that it promptly fell below that strike price. It fell below 42. And at that point, I covered it and I rolled it down to 41. And that was enough to buy me enough time for it to expire worthless by the end of the week. So I ended up getting a little bit scratched. I think I lost about $85 on that trade. But overall, we still had a pretty good week. And, the really important lesson to take from here is that when you have a trend that you're fighting, you need to be very careful with your sizing. And because the trend was negative, I sized my bets pretty small. And it's okay to fight the trend as long as you size your bets properly. I have a saying that I like to tell people, if you master the bet size, you master the game. If you're going to be wrong, you want to be small when you are wrong. So for this week, I'm still staying pretty aggressive. I have some put options at the 380 level. I have some also at 375 and another layer at 373. Plus, I am short some VIX options, VXX, at the $70 strike price. So I'm leaning pretty aggressive for this week. I think the recovery that we saw last Friday will continue into this week, and I think it's going to buy me enough time to let these put options expire worthless. But if everything works, we'll make about $1,000 for next week. And also next week is the end of the quarter. So I'll be able to give you an update for how we've done for the first 3 months of this year Plus, it will also mark the 9-month anniversary for the pendulum algorithm. So I have some pretty interesting statistics I'll be showing you, and I think you're going to like what I have to show. So that's all I've got. Thank you so much for joining me, and I will see you next week.